results report. I am Angostura, Manager of Equities at Bourse Securities, and I'll be holding on for Suro today. Today, we'll take a look at recently released 9-month results for two of the local listed companies in the local stock market. Firstly, we start off with Trinidad Cement Limited, or TCL as we know it. Bottom line, the company would have generated a healthy earnings per share growth of 30%. Earnings moved from 32 cents to 42 cents. Revenue line was relatively flat. Company would have experienced some challenges in the third quarter in Jamaica, as the country itself would have experienced some inclement weather with the passage of Hurricane Beryl and some other weather systems, which would have impacted the operations of TCL in the third quarter. Gross profit was up 5.4%. Other expenses up 44%, as the company would have undertaken some increased maintenance in the third quarter, as well as overhaul of one of the kilns, which would have resulted in increased operating expenses in the third quarter. Earnings before tax was up 17%, and net income to equity holders up 30%, as the company would have benefited from a lower tax rate of 21.7% versus 26% last year. TCL continues to benefit from improved revenue growth. Over the 4-year period, revenue would have grown from 1.2 billion in 2020 to 1.7 billion in 2024 over the 9-month period. The cement segment continues to be the largest contributor, with revenues of 1.2 billion in 2020 to 1.6 billion in 2024. The concrete segment had the contributor to the overall top line, 69 million this year versus 53 million last year, and packaging relatively unchanged and a very small contributor to the top line growth. One thing to note, TCL does generate over 77% of their revenue outside of Trinidad, which is very good in this current environment. The company also continues to experience improvement in margins. Their operating profit margin would have moved over the 9-month period from 15.5% to 16.9% this year. And last year, the PBT margin was 13.4%, and this year it's 15.8%. And the PBT margin would have jumped from 8.8% in 2020 and 8.7% in 2021 to the current 15.8%. So this is definitely a positive direction for the company going forward. Our recommendation for TCL at this point in time is market weight. We do think the company would continue to benefit from stable revenues, improved margins, and importantly to shareholders, the company has resumed payment of dividends. The last time the company would have paid dividends was in 2017. This year, the company did pay 8 cents, and this translates to a dividend yield of 3.1%. Sector average is 4.3. The evaluation 6.8 times, and the sector is 9.9 times. So a relatively decent PE valuation for TCL. The next company we'll take a look at is Angostura Holdings Limited. Angostura would have experienced a decline in revenue and also earnings per share. The bottom line, earnings per share was down 10% over the 9-month period, falling from 51 cents to 46 cents. Revenue would have also declined 3%. The company would have experienced some challenges in the local market, the standard round segment, with some decline in revenues year on year, but this was mitigated by improved revenue growth in the international market with the Angostura bitter line. Gross profit was down 9% as cost of sales would have increased. Results from operating activities down 15%, PBT down 15%, and profit for the period was down 9.6%. Overall revenues have grown for the company over the last 4 years around 21%, moving from 574 million to 698 million over the 9-month period. Year on year, of course, it was down 3%, and it's down from the peak over the last 5 years of 711 million in 2022. In terms of their profit margins, the company has witnessed some challenge this year. The gross profit margin is down to 47.7% from 50.9% last year. Operating profit margins down to 16.1% from 18.5%. This despite the company undertaking some initiatives to control the operating costs, and then they did record a reduction in operating costs, but this was not sufficient enough to improve margins, as the company would have experienced increased costs at the top line in terms of cost of sales, and this will trickle down to the bottom line of the company. The profit after tax margin was up to 13.5% versus 14.5% last year. In terms of earnings per share, the company would have witnessed a decline in earnings per share. The last time the company would have witnessed 78 cents last year, and this year 69 cents. Over the last few years, the company has been recording earnings per share relatively with a range of 10 cents, 77 cents last year, 78 cents last year, sorry, and 77 cents in 2021. The last time the company would have recorded earnings per share of 69 cents was in 2020. So decent stability in earnings, but a decline nevertheless. The evaluations also very elevated at current levels of 23.2 times. This despite a fall in share price of 27% this year. 2022, the evaluations are very high to the 2.8 times. And this compares to a sector average of 9.9 times. Dividend yield at 2.4 and sector average of 4.3. Our recommendation, consequently, is an underweight. As you see, the company will continue to probably face revenue challenges in this current year, margin challenges as well, and more importantly, the relatively high valuations compared to other securities in the sector. One positive, the company, the new product offerings, the company did indicate to mitigate some of the challenges in the standard rum segment. The company are undertaking some initiative to change up the product mix and introduce new products to the suite of products that they currently have. But our recommendation will continue to remain underweight at this point in time. If you have any questions on today's segment, please give us a call at 226-8773. Email us at invest@boursefinancial.com or visit our website, bourseinvest.com. Thanks for joining us this morning, and please have a wonderful investment week.